people ask us for the recording, and we do post the recording of all of our meetups on our YouTube page. So we can drop, actually, Sarah, can you just drop our YouTube page link in the chat for people? So
can do.
Everyone join, or if you ever see something that we're hosting and you can't make it live, you can always join us there. All right. We're getting in. Oh, hi.
Hi.
All right. Perfect. Okay. Well, I'm going to get us started, you guys. It's noon Pacific time, and some of us are in different time zones. So just kicking us off here. Excited to have everybody joining us for a very exciting topic, which is to pay off your mortgage in 5 to 7 years without changing your income. And if you're looking at the attendee list, you'll see a familiar side, Sarah and I. We've got Larry on here, and Larry was a guest speaker of a guest speaker a couple of months ago. So when we talked about infinite banking, I think that was back in February, we had Larry on, and Larry is actually how I learned about this whole concept of paying off your mortgage in record time. So I met our guest speaker, Michael Lush, and his team, and they are filled with so many great tips and such great information about how to rethink debt. And honestly, like, Michael will talk to you about how he learned about this, but spoiler alert, he used to be a mortgage broker, and then he realized through some connections how the ultra wealthy finance their homes, and it is not with mortgages. So, not to steal your thunder, but it's pretty interesting and something that I didn't know. So if you follow us on Instagram, you probably saw the post and saw a little bit of video about what he's going to talk about today. But it's a very intriguing topic and something that is relevant whether you are just own your own home, whether you're an investor, whether you're aspiring to be one or both of those things. It can help you in so many different ways. And so Michael will be talking to us about that. And I think many of you know Sarah and I, we are your lovely hosts for the day. We are both investors, and this is the first time we're doing this only online. So love that all of you found us and that you're joining us here online. Oftentimes we do a hybrid approach. So some of you are in the office with us, some of you are online, that everyone is here. And we are realtors in Bend, Oregon and beyond, and we're both investors as well. So we have the Central Oregon Investor Network, which brings together investors from all over the country, truly. We've had people on these meetups from Mexico and Canada and all over the country, everywhere in between. And our goal is to help build community, share resources, learn from one another. And ultimately, our goal is to help this community create more free time and freedom through passive income from real estate investments. So anything you want to add, Sarah?
You always ask me that question. You do such a good job of covering it. Again, I'm just always grateful to be here. I'm always learning something new from these meetups myself. And we're just grateful to create a safe space for our investor community here in Central Oregon and beyond. So thanks for being here.
Yes. And just a quick call to action. If you are not on our Real Deal list, this QR code on this page will get you onto our weekly Real Deal list. And what that is Sarah and I scour the Central Oregon market every single week for the best real estate investment properties. And sometimes we feature things that are off the market. Sometimes we feature things from different areas. We are bringing the best of the MLS, the best of what's on the market and off the market to you every single week. We write the commentary, so we tell you what you think. We don't just regurgitate what's on Zillow and Realtor.com. So we put in what we think and why we think it might be a deal. And many of you who are joining us today have already been on that list, but if you're not, you should be on it. We share all kinds of great information and would love to have you join the Real Deal list. So you can grab that QR code there, and we are resources for you if you are buying or selling, of course, in Central Oregon, and we're resources for you with all kinds of investor topics and great relationships like Michael and Larry that you'll meet today. So quick agenda, we're following the usual flow. So we'll do quick intros and then we'll talk about paying off your mortgage in 5 to 7 years. So maybe you're paying more than necessary, how you can put these mortgage acceleration strategies into place, how cash flow positioning impacts your payoff timeline, the traps that keep folks stuck in long-term debt, and just a lot of it is what you don't know. And then when to use these strategies and when not to. And then we've got a way for you to learn more, connect with his team, and really dive into the great content that they have prepared for all of you and beyond. So quick intros. We got a lot of people and I got to keep adding. People are continuing to join, which is great. So what I'm going to do is I would love for everyone on this chat, if you are comfortable sharing your Instagram handle, your email, your phone number, whatever it is. This is a community and we're meant to connect with other people. That's why we do these introductions at the beginning. We want you to get to know each other. We want you to connect after this meeting is over. And the way to do that is to put some information in the chat where people can find you. So I'm going to go top to bottom with the attendee list here. So it's going to be in alphabetical order. And we're going to start with Brady. Welcome, Brady. Good to have you back.
Hey guys, just been joining Brady Webster here in Bend. Just always looking forward to learning something new. I'll just keep it short.
All right. Thanks, great, Brady. Carly, wonderful to see you again.
Hi guys, I'm in my little cabin that I just bought with Sarah and Suzanne. We've been in for like a month in Three Rivers. Lots of snow today, which is lovely. So in Bend, I guess I'm an aspiring investor. I've had rental properties overseas before, but just kind of getting going here. So yeah, just always happy to learn and meet new folk and see what's going down.
We're so glad you're here, and I love that you're in your sweet place in Three Rivers. Great.
I'm jealous of the snow. It's 84 and sunny here.
Oh, wow. Yeah. I mean, we haven't had a lot of snow and it's a bit late coming, but better late than never, right?
Yes. Excellent. All right, Dave, welcome. Good to see you.
Hi, folks. Always enjoy these meetings. Dave Budnick, local to Bend. We invest in single family and multifamily deals across the country and a small mobile home park in Mississippi, as well as building a memory care mansion in Redmond.
Wonderful. We're glad you're here. Great to see you again. Debbie, great to have you on. Oh, Debbie, if you're talking, you're muted. We'll come back to you. Gabrielle, welcome. Nope. All right, moving on. Ginger, hi.
Are you talking to me?
Hi.
Oh, nope, we're going through. Oh, are you
Okay.
different Ginger? We've got Ginger King here from upstate New York.
Hi, everyone.
Would you say you're an aspiring or experienced investor, Ginger, and what you're hoping to get out of today's meetup?
Oh, well, thanks for the cue. Aspiring, here to learn more.
Fabulous.
I'm very interested in the heading. I was like, what? So I come very curious and open and probably with pretty much everything to learn.
Excellent. We're glad you're here.
Thank
Holly, good to see you, Holly.
Hey, and I see Dave in there too. Hey, I always think I'm an aspiring, but I guess I'm doing it. I have a rental property up in Cornelius. I've done a couple of flips and I'm on contract right now on a house in Huntsville, Alabama that will become an Oxford house, which is sober living. And also after that gets settled, going to pour into more of my little side business, the listing babysitter, which is a listing support for agents and investors. And then maybe after that, I might get my real estate license. Doing that too. Working on that too.
I love it, Holly. Put your info
Never-
in the chat so people can find you.
Yep.
Love it. All right, Jason. Oh, yeah, Jason Hoffman. Quick little intro. You there? All right, we'll move on. John Tarantino.
Hi, everyone. I'm John Tarantino, and I have most of my experiences in property management. I've been doing that for about 20 years, but just on a small scale. I did work here in Bend for a couple companies for just a short time. And I do invest. I have invested. I have a property in Ohio that I've been working on as far as like trying to do a deal with the city, possibly a development. So I'm still working on that. And today, just looking to learn about, paying off our mortgage. I'm always interested in getting that mortgage wiped away and just owning the house free and clear. So the sooner we can do that, the better. And so, yeah, thanks, Sarah and Suzanne, for hosting this. As always, you guys do a great job.
Thank you. Karen Benson, welcome.
Oh, thanks. My name is Karen, I'm a real estate investor. Been since the mid-70s, and split my time between Texas and Bend. I have real estate interests in both areas, and I have learned that my network is my net worth. So I always like to meet new people in real estate. Also have off-market property in Bend and some in Texas. So just here to learn more.
Excellent. We had a little bit of mic issues with you. So if you want to just put any info in the chat, that'd be great, just in case folks want to reconnect with you afterward.
Thank you.
Yeah. Karen, great to see you.
Thank you.
Hey, everybody, can you hear me?
Yes.
Yeah. Hi, Karen Rugg. I am a licensed GC here in Oregon, and we've been doing some fix and flips around Bend. Yeah, I guess just in Bend, actually. All our flips have been in Bend. And hopefully we'll get it on the market here in about a month. Worked with Suzanne and Sarah. This will be our third transaction, and they're amazing, and I love them. So if you if you need anything, you should reach out to them.
Thanks for the plug, Karen. Maylin, wonderful to see you. Welcome.
Hello. Good afternoon, everyone. So I'm out here in California. I do, I guess I'm an aspiring investor too. We have a few rental properties here, and then we have a few condos out of state, but excited to be here because I have a lot of mortgages and would like to figure out how to get them paid off quickly.
Yes.
Thank you for hosting this.
For sure. Sunny, welcome.
Well, hello. This is not actually Sunny.
Oh,
but my son and I own the business Central Oregon Mobile Truck Wash, but that's where we're at, is like looking to invest in another property, but want to know how to pay off the mortgage we have now much quicker so we can invest more in other properties. So that's where we're at. And that's why I'm here. Hi. There we go.
Oh, your video. What's your name?
Denise. And I've come to a couple of your other ones. You guys always do amazing work. I appreciate the info that you give out, because I'm not investing yet, but getting there.
Perfect. Well, make sure to put your truck wash info in the chat. People ask us for all kinds of stuff all the time. So
yeah, we wash buildings, commercial buildings. We do a lot of different things. So, yeah, absolutely. I will get that info out there.
Great to have you.
So thank you.
Yeah. All right, Stefan, welcome. No, Mike. All right, moving on. Taryn, great to see you again.
Hi, I'm Taryn. I am a wholesaler in all the West Coast and Texas, Arizona, Michigan, Ohio. We actually are nationwide, but those are kind of our main markets. And I'm also a multifamily and single family investor here in Central Oregon. And I'm just here to network and put my name out there, but also learn. I want to pay off my mortgage on my primary. So I'm excited.
Yes.
Excited to see some familiar faces. And thank you, Holly, for making me laugh always.
She does do that, doesn't she?
Yes.
All right, Tim, welcome.
Hey, Suzanne. Yes, my name is Tim McDowd, and I'm definitely an aspiring investor. In fact, I'm circling around our first transaction with Suzanne and Sarah now, in between home ownership. So we're renting now after selling our home last summer. So just trying to figure out what's the smartest and best next move.
Perfect. We're glad you're here, Tim. All right. Well, look at us. We're on time. This is amazing. We oftentimes go over. But all right, we have Michael Lesh here to talk to us about how to pay off your mortgage in 5 to 7 years, even faster, honestly. And I'll let him do a little intro. And just a heads up, the QR code here will take you to a website where you'll see a video and you can learn more about what he's going to talk about today. We'll flash this again at the end of the conversation. So if you don't catch it now, you'll get it at the end, and we'll hand it over to you, Michael.
Thank you. Yeah, I'm out of Franklin. I guess I'll do an intro to myself. I'm out of Franklin, Tennessee, which is why it's hot and humid here versus snow. As far as investment, obviously investing in my own companies, which center around banking, insurance, fintech, crypto, et cetera. But actually, two things that I'm most passionate about right now is, surprisingly, laundromats, as far as investing in laundromats. And then 2 years ago, we started a charity called Funds of Freedom, and we fight human trafficking and sex trafficking here in the United States. So got friends that do it abroad, but we felt a little bit more patriotic and wanted to do it here in the country. So those are two of my passions so far. Well, awesome. All right. Well, I'll kick this off. It's my first time. I think first time. I haven't used Google Meetup in a long time, but I'm going to see if I can get through this. Let me know if you guys are seeing my presentation on your end.
We got it.
Good. All right. Well, let me see if I can actually toggle through it. Thanks, Ginger. You and I share the same name. I have some of my buddies call me Ginger.
Love that.
Maybe let me try this. Presenter mode.
So if you can do either. There you go.
All right, got it. So allow this time. Sounds good to me. Okay. All right. So yeah, what you're going to hear about today is Replace Your Mortgage. We have several verticals underneath Replace University, but what you guys are probably most interested in and want to hear more about is Replace Your Mortgage. I heard somebody talk about infinite banking. We do that as well underneath Replace Your Bank. Not to solicit for that. It's just to say that if you ever come to a crossroads where you're like, well, I wonder if I should do this or infinite banking. Actually, they work perfect together. Replace Your Mortgage can take your IDC goals and actually put it on steroids. So I'll get right into it. So as far as myself, I'm the CEO and founder of Replace University. We only focus here in America. I've had quite a few other companies kind of pull on me a little bit to kind of go internationally, but until we have solved the problem here in the United States, I don't feel like going internationally. The only purpose to go international is to make more money. And although I'm not allergic to money, my biggest mission is to have more impact here in this country. I've been in the mortgage and banking industry for a total of 26 years. 17 of it was exclusively on the mortgage side. It was my first gig outside of college, and kind of rose from the ranks from loan officer to my last station was a senior vice president for a federal bank. And obviously I'm called to be I authored a book, again, not soliciting for the book. In fact, I think if you even went to Amazon to buy it, the money doesn't even come to us. It's something we've been working on for a couple of years with Amazon. So, but yeah, there's a book out there. It's a little dated. I wrote that back in 2015, but I also contribute to Forbes, New York Weekly, to name a few. What I'm going to try to do is take what normally takes us about 6 hours to present and condense it down to 40 minutes. So tall ask, but I think I put together the right presentation to give you enough high level value. So it kind of gives you an idea of who we are, what we do, and why we do it. So first off, I want to talk about what I consider the mortgage trap. You know, this is what I did for a living. I provided mortgages. Let me see if I can get this Google Meetup thing out of my way. There we go. I think so. There we go. You know, I did mortgages for 17 years, and the history of that is back in 2009, after the resurrection of our firm. I worked for the 9th largest lender as a senior manager, and we went bankrupt actually on my birthday in 2007. And in 2009, we had gotten our capital from a hedge fund, and a very unique hedge fund, one that invests in mortgage-backed securities. And the hedge fund owner, his parents lived in Nashville. So from time to time, he would travel to Nashville. At the time, I was living in Charlotte, North Carolina, where I was heading up operations there, wanted to move back home to Nashville. I was like, hey, I don't have a job. There's no industry left for me, so I'm going to move back to Nashville, and I did. Well, that same company came calling and said, hey, we'd like to make you director of operations and open up a location in Nashville for us. So I did. But his parents lived in Nashville as well. He was out of Connecticut. So from time to time, he would fly into town to meet his parents, but he would also stop by my office really just to check up on his money, to make sure it's being spent well and that we're heading in the right direction as this newly resurrected company. And that's when he hit me with it. And there's one line that he told me that I think it stuck with me, and I think it'll stick with you guys too. You know, at the time, this gentleman was worth $600 to $800 million. Today, he's a billionaire. He's the king of hedge funds as far as leveraging other people's money. So when I hear real estate investing, I would imagine that's what you're doing. You're not paying cash for it. You're leveraging other people's money, and that's what they do. But he said that I actually tried to solicit him. Said, listen, you know, you're where everybody would love to be, unless you're Warren Buffett and you're taking quite the pay cut. But nonetheless, you're super wealthy, and people would love to have the resources that you have. So, birds of a feather flock together. If you could just introduce me to your circle of influence, those folks are probably doing big mortgages. Big mortgages are big commissions, big paychecks, and a lot of profit. So you get your money paid back faster. And that's when he hit me with this one line: is mortgages are theft. It's really financial crack to middle America. The rich don't use them, and the poor can't afford them. And so I understood the poor portion. I wasn't getting poor people qualified to buy a home, but the rich portion of that sentence really intrigued me. It's like, what are they doing? And that's when he hit me with 15 minutes overview of what they do, which is honestly against the grain of everything I had been taught and everything I had been espousing to my clients up until that point. Is that simple interest lines of credit make far more sense for the right people than mortgages ever will. So we're going to talk about the mortgage trap, how the system really works against you. And then I'm going to transition into what the actual strategy is, the payoff plan. Because most Americans have been taught to think that a mortgage is the only solution when financing real estate, when in fact it's the actual problem, and that mortgages didn't always look the way that they do today. Sorry. There we go. All right. I love this quote. This is from Henry Ford. And if you can kind of think about the time that Henry Ford was in, a little bit later than J.P. Morgan, the Rockefellers, Carnegies, and whatnot, but a titan of the industry. And a lot of people today even use the same quote. It is well enough that the people of the nation do not understand our banking and monetary system, for if they did, I believe there would be a revolution before tomorrow morning. What was it that Henry Ford understood of the transition from our previous monetary system to the new monetary system? And I'm not just referencing fiat money. I'm referencing a complete change of our financial structure, which I honestly think that we're in the midst of today. I think the financial system we've had for about 100 years, a little over 100 years. And now with technology coming on the scene, better technology, I think we're about to see a pretty significant shift of how money flows through our system. What mortgages used to be, mortgages prior to 1913 looked entirely different than they do today. And the reason I use 1913, well, actually, I don't want to spill the beans because I think it's later on in my presentation, but mortgages, which equates to death pledge. And when I say equates, that's the translation of it. Mortgage is Old French for death pledge. Mort referring to mortality, gage referring to contract, so it translates to death pledge. Mortgages looked very differently than they do today. So back then, they honestly looked very much like an open-end simple interest line of credit, like what you would consider a home equity line of credit today. That's how mortgages were back then, where you really had control over three of the major components of borrowing. That's the rate, the balance, and the time. Now, if I were to ask you guys a question, out of those three components, what do you think would be more important to you as the end consumer? 99.9% of consumers would say the interest rate. That is not the case. And I'll prove why that is not the case. We focus on interest rate, and we have been indoctrinated and marketed to and advertised to focus on that number, because that's the sexy number. That's the easiest number to sell. But I'm going to show you throughout this presentation why the interest rate doesn't reflect how much interest you actually pay. You know, if you were to drive down the interstate and you see a billboard for a lender, what are they marketing? The interest rate. You know, if you watch Super Bowl and there's a commercial, what are they advertising? The interest rate. So we've been taught to focus on the interest rate. And really, this is a unique issue to America. If you were to go to Australia, United Kingdom, South Africa, parts of Brazil, Japan, they don't look at financing real estate as one singular thing to focus on being the interest rate. They look at the totality of how much it's actually going to cost to own real estate. I'll give you an example. I remember, a couple decades ago, I bought a house for $320, ended up selling it for $450 10 years later. Now, does that sound like a good real estate deal that I made money? Yeah, on the surface, that would be the case. You would say, yeah, you went from $320 and you sold it for $450, you made $130,000. But if we don't factor in what are the financing costs of that, and a lot of you guys are real estate investors, so you're picking up on this, I would imagine, pretty quickly. No, I lost money, especially because I financed it on a mortgage. The first 10 years of a mortgage are predominantly interest-only payments. Mortgages are front-loaded with interest so that the bank gets their profits first. Really, when you finance a home with a mortgage, you're paying for two homes, one for the bank and one for you in that particular order. And because I did a 30-year term, and it doesn't really matter if you do a 30-year, a 20, or a 15, or a 10, they're all front-loaded. It's just how much of it is front-loaded in the beginning. And the reason why banks front-load it with interest is they understand the buying behavior of America. One, as Americans, we buy payments that we can afford on a monthly basis rather than focusing on the total purchase price and cost of financing for a home. So I'll repeat that. We focus on the payments we can afford inside of our monthly budget than the actual total cost of owning that home. So if we have $10,000 a month coming in, the payment on that home is $3,000, and we've got some margin there, we're like, hey, green light, sounds good to me, because it fits inside of our monthly budget. We finance everything as Americans. Now, I'm not saying that you shouldn't finance anything, and I want to kind of spill the beans here too. Some of you have said, hey, I want to learn how to pay my home off early. That's fine. If you want to do that, I'm going to show you a perfect way to do that. And up until this point, we've been at this for 12 years. I've been personally doing this for about 15 years. Haven't found a better way yet to get out of debt. But once you get a handle on it and you understand how to control that, then you need to ask yourself a really important question is, do I actually want to be out of debt? And there's no wrong answer to that. Depends on where you are in your life cycle. I did it once. Back in 2016, I paid off my home. It took 3.5 years for me and my wife to pay off our home without changing anything about our lifestyle, anything about our budget, anything about our income. We just changed where our money went and when it went there. But once I did that, and I got the zero, I got the statement from Wells Fargo, and I was proud of it. But then moving forward, that was 14 years ago. I haven't done it since. So there is no wrong answer. Maybe you want to be debt-free and not owe anybody anything. But once you understand how to control this and how to better finance real estate, then you could also leverage it to grow your net worth. That's not a wrong answer either. So I'm not here to say I'm on the bandwagon of Dave Ramsey, get everything debt-free and then start investing. I wouldn't say the opposite. I'm like, let's control debt and let's understand how to finance debt more efficiently. But is there better opportunities that I can leverage my capital, my access to capital via a home equity line of credit to grow my net worth? And that's what we do. So yeah, back then you could control rate, time, and balance. Now that is not the case. So again, that was before 1913. Borrowers controlled all three factors, rate, time, and balance. I would argue that now we don't even control any of the three. It used to be prior to 2008, different lenders had different interest rates. You call somebody up, they had 5.5. You call somebody else up, they had 4.5. Over here, they had 7. Programs where it was a wild, wild west. different lenders, different appetite for risk, different programs, different interest rates, different terms. Now that is not the case. The government controls about 75% of mortgages on the secondary market today. So it's all very vanilla. I don't care if you're in New York, California, Oregon, or Florida, interest rates are pretty much the same everywhere you go. The only difference, and some of you guys are realtors here and real estate investors, is the service of the lender. That's about it. An FHA loan is an FHA loan. A USDA loan is a USDA loan. VA is VA. Fannie, Freddie, they're all the same. So the interest rates aren't all that different. But Farmer John, prior to 1913, a mortgage, same term, just different structure, was a line of credit. It was an open-end borrowing, simple interest line of credit. So I'll give a real-world example of this. Let's say Farmer John had a $200,000 farm, and he owed $100,000. He could take the horse and buggy down to the bank that day and say, hey, I need to borrow 10 grand to buy more farm equipment because I want to cultivate more crop. And I'm like, no problem. We see the value. We hold the deed to the home. We see what the balance is. So worst case scenario, back then, banks wanted to be in real estate. Now they don't want to be in real estate. They don't mind lending on real estate, but they don't actually want to own real estate. And again, somebody else mentioned infinite banking concepts, and anybody can research this with the FDIC, is that banks actually now own more in insurance than they do in real estate holdings. It's called BOLI, Bank on Life Insurance. But again, not to geek out on the insurance side, I'm here for one topic. But Farmer John would go down that day and borrow 10 grand. And it was that day he got the 10 grand. He'd go and cultivate more crop. Let's say it was 20 grand. He would take the 20 grand and put it right back in his mortgage, because back then mortgages were extremely liquid, where farmers could do that. And it wasn't just farmers, it was your everyday homeowners as well. So if you do the math there, you got 100 grand, then he borrows 10, it goes up to 110, then he makes 20, puts it back into the mortgage, he's at 90, right? If you think of, here's a good example. It's a Wonderful Life. We just 4 months ago came through Christmas. It's one of the Christmas movies. We watched like 20 of them, but that's one of the Christmas movies we love to watch. And if you understand what's happening in It's a Wonderful Life, is there's a run on banks. That was happening a lot in the early 1900s. So people didn't trust banks. They didn't put their, all their money and their nest egg into a checking and savings account. They actually put it into a mortgage for safekeeping, because in an instance that I just explained, like Farmer John, if they needed access to it, they could go down the same day and get access to their equity. That is no longer the case. Then we had, obviously, 1913, which is the institution of the Federal Reserve. It wasn't our first attempt of a Federal Reserve in this country, but it was the one that actually stuck. There's a good book out there that you can read, The Creature of Jekyll Island. I remember reading that like 25 years ago and still having conversations where people thought that was like some type of conspiracy theory. Like, no, this is a historical document. This really happened. J.P. Morgan owned Jekyll Island. He and some other investment bankers and politicians had a private meeting off the coast of Georgia. And what came out of that meeting was the blueprint of the Federal Reserve. So the Federal Reserve allows banks to execute what's called fractional reserve lending all the way up until 2020. So what fractional reserve lending does is it allows banks to lend out 10 times up until 2020, and I'll get back to why that changed in 2020, lend out 10 times what they had on deposits, right? So think of it this way. So a really cool magic trick. Let me see if I got some cash here. This is all fake cash. I'm in my studio here, so we got fake prop money. But imagine, putting $100 into the bank, and now the bank has $1,000 to lend out. Well, that's a pretty powerful magic trick. If you and I had that ability, the next question we would ask of the person giving us $100 is, can you give us more, right? Well, that's no different than what the banks did. So, if you got 100,000 deposits, they can lend out $1 million. You had $1 million in deposits, they can lend out 10 million. Now, obviously, what they're paying for the deposits is a lot smaller than what they're charging to lend it out. It's called arbitrage or margin, and that's how banks make their money. So, on top of, how did banks get around to convincing the average consumer to deposit money in their checking and savings account? Because again, people didn't trust the banks. Once the banks got a hold of this magical trick, which is fractional reserve lending, they got together and said, we need to restructure what a mortgage does, because where's the average consumer storing their capital? They were storing it in their mortgage for safekeeping. So they made a simple change. They made it a closed-end amortized loan instead of an open-end simple interest line of credit. Now think about you as the consumer. What does that force you to do? You know, how many of us here are actually storing 100% of our capital inside of our mortgages? None. Why? Because it's a closed-end instrument. We need that capital. Maybe it's to pay groceries or bills or utilities or to invest. It's not liquid, right? That's what the average consumer did back then. So instead of putting their money and their capital into a mortgage, they would only put some into it. And then they would have to have other funds left over for the everyday expenses, which the banks came along and said, here's our welcoming hands. We'll take on your capital in the form of checking and savings accounts. Now, on top of that, they made a mortgage front-loaded with interest. And I explained that earlier. The reason why it's front-loaded, they want to gobble up their profits first before you have an opportunity to refinance or sell that home. So all of them are profitable, which is why, you know, you guys being realtors, you probably work with lenders, and lenders that do a lot of volume, they have a really good living. You know, they can make 1% to 2% of the total loan volume. So they're very profit. And where profits come from? Profits, or commissions, I should say. That's what the loan officers get. They get commissions. Where do commissions come from? Commissions come from profits. Where do profits come from? Consumers overspending. And I'm going to show you a product that all banks and credit unions have. And they're all slightly different from one to the other, because it's still the wild, wild west in the banking world when it comes to these equity products. But they don't have commissions. Why don't they have commissions? Because there's very little profits. Why is there very little profits? Because there's very little of consumers overspending. So right there, you're at a crossroads. Which product do I want to consume? One that has lots of profits and bigger commissions because I'm overspending, or another product that has no commissions because there's lower profits, therefore I'm not overspending. So that's essentially what I'm going to get back to. But the mortgage being front-loaded with interest, it now disrupted the 3 points of borrowing: rate, term, and balance. Now you see that time and balance is grayed out there, or I think it's red. Is it red, Sean? I think it's red. Sorry, I'm colorblind, guys. So it's obviously it's not something that we can control, but then rate is. And again, I said it earlier, I think I would argue that point too, because it doesn't matter if you're talking to a lender in Florida or New York or Oregon or California, their rates are going to be pretty similar. You might have 0.25% difference in interest rates. So I would argue that that's not even under our control at this point either. So the mortgage trap, you know, Farmer John used to use lines of credit for both his income and expenses, but now the modern day mortgage has restricted his access to that equity. So it forced him to open up checking and savings accounts. So that now what follows for generations is financial resources are now becoming stretched more and more thin. That you wouldn't see this in Australia. What I'm talking about, they teach in high school. And I'll give you a couple of fun facts too. In Australia, 84% of Australians, this is normal to them. There, they call it the money merge account. And the reason why they call it a money merge account is you're merging two utilities and two products into one. Your home loan and your checking account all become one. So 84% of Australians do this. They also happen to be the country with the highest rate of second home ownership, because the average Australian has 2 homes paid off in 14 years, where the average American doesn't even get one paid off in 30. And you're like, how is that possible? Why, if it's a 30-year term, how's it not paid off in 30 years? What did we do in 2021, 2022? We refinanced for those attractive interest rates. And so we may have been 5, 10, 15 years into our mortgage, but then we get a chance of a lifetime of 2.5%, 3% mortgage rates. So we take advantage of it. We refinance to get that lower payment, but then we reset the clock all over again to 30 years. So we may have been increasing our margin for our budget on a monthly basis, but we actually long-term didn't save any money. We actually cost ourselves tens of thousands, if not hundreds of thousands of dollars more. That's why Americans don't, on average, pay their home off even in 30 years. So let's talk about banks and how it works for them. You know, again, banks lend money to customers at a higher rate than they pay depositors or than they borrow. And that difference is known as margin. It's kept by the bank. And I want to get into, we've got, we're at 2:38 my time, so we probably got some time for this. Your checking account is a liability. Your savings account is a liability. Your CD, your money market, those are liabilities. Why is it a liability? And the more you have in it, the more of a liability you have. because the interest rate that you get for your checking and savings account does not keep up with the cost of inflation. So you deposit your money into the bank account. Right now, the average savings rate for a checking account or internal rate of return for a checking account and a savings account is 0.17%. It was actually higher when rates were lower, believe it or not. So as rates have gone up to 6.5%, 7%, you would think that the rate that the banks give you on average for your checking and savings account would actually go up. It actually went in the opposite direction. So it's 0.17%, but the average historical inflation rate is 3.3%. So this is why I'm explaining why it's a liability. What is that negative rate of return? It's negative 1,841%. And you're probably asking, well, why is that? Because you're thinking of margin between 0.17% and 3.3%. The easiest way to reframe this is take the percentage symbol off and substitute it with a denomination. How many times can 17 cents go into $3.30? That's why banks have the tallest buildings in every major city you go to, because it's extremely profitable. It's an 1,841% rate of return. So right off the bat, I'm sharing with you that the more money you have in a checking and savings account, the bigger of a liability you have, because you're not optimizing your cash flow. Your cash flow can be better used doing something else rather than sitting in a checking and savings account dying, essentially. Think about every dollar as an employee. If it's an employee, in your employer, are you okay with your employees sleeping on the job? Absolutely not. And if they were sleeping, what do? You fire them. Well, what I'm saying is let's reposition that cash flow so that 24/7 our cash flow is actually doing something positive for us, as opposed to just being stored in something that is eroding in value. This is what we currently work with as far as an operating system. When you have a mortgage, you have to adopt this system, and I call it the segregated income approach. So you got income coming in, it's going to one of two buckets. It's going to checking account, and from the checking account, it goes to the mortgage. Maybe some people pay extra on their mortgage, biweekly payments or what have you, maybe pay extra towards the principal, but some of it's going towards the mortgage. Some is going towards credit card debt if you have it, student loan debt, your bills for utilities, etc. And then we have another bucket over here called the savings account. And that some may go towards retirement or a vacation fund or emergency fund. So what we're doing is we're constantly splitting up these dollars. And every time you split them up, they lose more and more power to be efficient, right? So your bank account chains your wealth as a liability. Again, your dollars, they're employees. And they're sleeping on the job and still getting paid to do so. What would you do as a boss? So we have to start optimizing our payroll. And, people ask me all the time, why do you feel like so many, we've hit all-time records, whether it's mortgage debt, credit card debt, national debt. Why is it that Americans have so much debt? And I start with the mortgage because that's when it changed everything for Americans. We have mortgage debt, which forces us to segregate our income because it's no longer a product where money can move in and out freely 24/7. It's a closed-in product. Money moves in easily, but it doesn't come out easy. We have to refinance or sell in order to get access to that capital. Well, since it does that, now we can't afford car loans either. So then we do installment loans, amortized debt for car loans. Then we have credit card debts because we can't afford vacations. And we have student loan debt because we can't afford higher education. That's why I think it all starts with the mortgage. And again, you're hearing this from somebody that did mortgages for 17 years. So who is in control? And if you look at how a mortgage works, in this graph that you see on the left, this is based on a 4.25% mortgage rate, right? So if there's a 6.5%, 7% mortgage, it's actually worse than this. But the blue line is your interest payments and the principal payments is the red line. And eventually they cross. At the point that they cross, what that means is your payment, let's say it's $2,500 a month. In the beginning, basically interest-only payments. But over time, more and more is starting to attack the principal. But at what point does that $2,500 mortgage payment actually affect more principal than it does interest? On average, that's 222 months in. That's 18 and a half years that you're into a 30-year mortgage if you never refinance, so that your payment is now starting to pay off your house versus paying off the bank's house, hence where the profits come from. So again, I'll go back to what's the number one factor we used when we chose our mortgage? It was interest rate. But the thing is interest rate does not equal interest cost. What you see isn't what you pay. And so the truth is actually hidden in plain sight, and it's actually disclosed to you by the banks and lenders. And here's the disclosure. It's called the loan estimate. Prior to 2010, it was a good faith estimate, but in the government's infinite wisdom to make things more efficient and consumer friendly, they took a one-page document and made it 3 pages of absolute nonsense. But anyways, page 1 is of your loan estimate. It spells out what your loan balance is, what your interest rate is. If you see on the left, that's a 3.875% interest rate. On page 2, it's breaking down all of your closing costs. This is where I'll tip my hat to the mortgage lenders. And just a little tip to the realtors too. The good ones already know this, but there's a lot of realtors out there like, my goodness, their closing costs are so high. It's not all the lender's fault. Most of the closing costs actually come from the title companies. And in today's day and age with technology, especially blockchain technology, I don't know why title lenders or title insurers actually exist. It's an obsolete business, and it's actually, most of the cost is being passed on to the American consumer when blockchain technology could do it for a couple pennies. But again, I'll get away from the fintech side. So you're looking at this, you're like, hey, right now rates are 6.5%. Who wouldn't kill for a 3.875? The interest rate only dictates what your monthly payment is, but it doesn't dictate how much interest you actually pay long term. Time and balance are far more important than interest rate. So we're looking at this and we're like, all right, 3.875, that's a good deal. But if we go to page 3, we actually see what TIP is. Years ago, I used to ask folks, what is your rate of interest? And they would tell me 3.875. I'm like, no, that's your interest rate. I want to know what your rate of interest is, what you're actually paying in interest. And they're like, I'm confused. But everybody gets disclosed the same document. If you have a mortgage, you've got this document. It's just 99.9% of Americans never actually look at it. Even at the closing table, even if the loan officer's there, like, look, this is the interest rate I promised you. Here's the payment you said you could afford. Here's the loan amount and the cash to close. We good? Yeah, we're good. All right. Just flip through all this other stuff and initial and sign. Nobody takes the time to actually go over the 3rd page of the loan estimate. But on a 3.875% mortgage, the TIP, total interest percentage, which is the real rate of cost, is almost 70%. That's a payday loan. Why don't they lead with that? I mean, that's the real number. I mean, I'll give you, here's, in other words, it's spelled out right here. The borrower will pay back $162,000 in principal and over $112,000 in interest if they never refinance. If they do refinance, it actually is a bigger problem. So how is that 3.875? The true cost is 70% because we can easily do the math that 112 divided in 162 is 70%. But how can we explain that 112 equals 3.875? We can't. That's why you need 3 pages to confuse people as opposed to just 1 page to say, hey, the total cost of financing this home is going to cost, if you never refinance, 70%, which means we're going to make $112,000 off of you before you start paying on that $162,000. That's the modern day mortgage. And here's the other thing. I want to now illustrate why time is far more important in mortgage terms, not even in HELOC terms or personal lines of credit or business line of credit terms. Just in mortgage terms, I'm going to prove to you that time is far more important than interest rate. In $250,000, you got a 30-year and a 15-year. Well, look at the 30-year. You got $456,000 of interest. 15, $344. So you're saving over $100,000 of interest by doing the 15-year term. But the 15 is still front-loaded with interest as well. So now we're just looking at time. So I've got a trivia down here. Which costs more? And if you can see it, I'm sorry, the print is a little smaller. Scenario A, $300,000 loan at 3%, 30-year term. Scenario B, $200,000 loan at 4%, 30-year term. Which one costs more? So I think there's a chat even on Google Meet. Sorry, I'm accustomed to Zoom. So if you could put in the chat, which one, scenario A or B, which one costs more? The lower rate or the higher rate? Is somebody chatting? I can't see. A. Holly says lower. Yeah,
Holly always.
That's true. Actually, it's funny because I have an event next week and we'll have a couple thousand people on, but more people. And I'm doing the condensed version than I'm doing here. So I'm somewhat leading the witness. But most people will say, Well, actually what costs more is going to be the higher rate, because that's what we've been conditioned to think. But you're 100% right. The lower rate actually costs more. Why is that? Because of balance. You've got 200,000 at 4% versus 300,000 at 3%. So A actually costs more, even though it's a lower rate. Here's another one. Which one costs more? Now we're going to solve for time. And I got that backwards. Before we're solving for balance, now we're solving for time. Scenario A, 300,000, B, 300,000, but you got a 3% and a 5%, 30-year and a 15-year term. So we already know the answer, that A is going to cost more. So now we've understood that time and balance are far more important than interest rate. So we have to stop focusing on the interest rate and start focusing more on the rate of interest. All right, now let's start getting into how we solve this now that you might be sick to your stomach. Loan balance and time matter more than rate. Lower interest rate does not equal less interest paid, and the fastest payoff almost always wins in total dollars saved, even at a higher rate. Now, I'm not here to tell you that the alternative financing tools outside of a mortgage are actually higher rates. Me and my team, we actually find rates that are much lower than mortgages. So are we focused on interest rate? No, we're focused on time, balance, and cash flow positivity. That's the most important factors of financing real estate. But if we can get some small wins by having a low rate, albeit we'll do that. But I'll also say something that, social media always gets a little bit of a stir, is I would rather have a 9% HELOC than a 3% mortgage. Why? Because I'll pay less interest on a 9% HELOC. And I'm not here to tell you that HELOCs are 9%. They're not. I mean, you can get 1.99 for a year, 3.5 for 5 years. I mean, they're all over the board. But let's assume that they were 9%. I would take the 9% home equity line of credit than the 3% mortgage every single time, because I can put 100% of my cash flow into that 9%, where I cannot put 100% of my cash flow into the 3% mortgage. And my cash flow positivity drives down the balance, and the interest accumulates entirely different in a simple interest line of credit tool versus a mortgage that's amortized. So we're going to use line of credits, whether that's a home equity line of credit, a personal line of credit, a second lien position. There's different kinds of home equity lines of credit too. There's first lien, there's second lien. Most people don't know what first lien means. So if you have a mortgage, you can actually refinance the entire mortgage into a home equity line of credit, even if you have very little equity. The first time I did this back in 2011, that's what I did. I only had 10% equity in my home. And I remember talking to 10 different bankers, and I said, I want to refinance everything to a home equity line of credit. I don't want a mortgage. I just want a first lien position home equity line of credit. Every single banker looked at me as if I had 3 heads. It's because they didn't understand the true nature of it, which is it's just a refinance. I'm not using my 10% to pay off my 90%. I just want to restructure the 90%, which is the mortgage, into a different debt tool, which is a home equity line of credit. And once it got escalated to, maybe a bank manager or the chief risk officer, like, oh yeah, this is a no-brainer. We would love to do this because we'd rather be in first lien position rather than second lien position. So that's a first lien position. Second lien position is your traditional home equity line of credit. You could do this with a personal line of credit. You could do this with a credit card. You could do it with a business line of credit. But a simple interest line of credit that is optimizing your cash flow is going to reduce your interest costs every single day. And you're also going to maintain liquidity because you'll have 24/7 access to your capital. So as you're paying it down, that's really the biggest thing that we have to guard folks against in our program is, 2-3 years from now, you're going to have access to $100,000. The myth is this is going to require more discipline. It actually requires less discipline to do this, and I'll show you why here in a little bit. But the discipline that it does require is to resist temptation, because most Americans have never had access to a couple $100,000. And if you had a couple $100,000 in your bank account, what would you do with it? Well, I'm going to go buy this car, or I'm going to go buy this boat or something like that. That's the type of discipline that is required, is now that you have access to capital, to not use it to buy things that are not appreciating assets or cash flowing assets. Let me show you this. So once we have a simple interest line of credit, you now see that you have control over all 3 factors again. You have control over rate, you have control over time, you have control over balance, because it's an open-end simple interest line of credit. And again, the payoff plan, this is not a refinance. It can be as far as refinancing your current mortgage into a home equity line of credit, but think of it as a complete restructuring and a paradigm shift of how your cash flows through these products. And again, it's not a simple product. It's a process. It's a complete strategy. And it's also not a dream. This is a strategy. We've got over 10,000 clients, and our average client, if they want to, pays their home off in 5 to 7 years on average. The fastest we've seen is 10 months. The slowest we saw is about 14 years. That was a newly married couple. And I guarantee you they're no longer on pace because that was the number based on their existing income and where interest rates were. Interest rates got better as they age and get, more certifications. They make more money, the more cash flow positivity. Guess what? That 14 number continues to trickle down. So just as we analyze something and we say, hey, it's going to take you 10 years. That's if your income never increases, your expenses never decrease, and if interest rates never go down. Well, that's not the world that we live in. All right, so let's talk about how it works. Cash flow is king, right? So all of your income is going to go into this simple interest line of credit. Let's just use a home equity line of credit. If you get a home equity line of credit, the right type, you're going to have all the same tools that you have inside of a checking account. You're going to have online bill pay, free overdraft protection. You're going to have a debit or a credit card associated with it. You're going to have ATM withdrawal capabilities. You're going to have check writing capabilities. All the things that you use for a checking account, let's call it the operating account, you have all those same tools with a home equity line of credit. So all of your money, every single thing that you make, think of it as a great place to park your cash. It goes into the line of credit. Money that goes into a mortgage goes to interest first, then principal is calculated. With a simple interest line of credit, when you put money in, it goes to principal first, then interest is calculated, right? So we're going to put all of our money, whether we have somebody mentioned infinite banking concepts earlier. Actually, I'll pause real quick and kind of show you what my flow of money looks like. This is what we'll be training on next week. Flow of money, income comes in. Can you all see this okay? Yeah, it looks like it's come through pretty good. Income comes in. Let me scoot it up here just a tad. Income comes in, it goes to the HELOC. Great place to park cash, and I get a dual benefit. Not only am I liquid, it's reducing the principal, therefore it reduces my interest costs. But if I find a better place for it, which I do, it's my infinite banking concept policies. That's insurance, where I get guaranteed growth, tax advantages, but I'm also still maintaining liquidity there. So the reason why I do it in this order is there's no limitations of how much money I can put into my home equity line of credit. In insurance, if you know, there are some limitations. You can't put 100% of your income into your insurance policy. So as much as I possibly can, it goes into my insurance policies. From there, I'll do policy loans to acquire assets, specifically cash flowing assets, dividend paying assets, which does what to my income? My income goes up. So if my income goes up and it gets parked over here again, what happens? Balance comes down, access to more capital, buy more policies, more assets, and it's a complete system. So super, super simple. So all of your income is going into it. Your balance drops, your interest rates recalculate every single day. Think about it. If you put $100,000 towards your mortgage today, what's your mortgage payment going to be tomorrow? The same. It's an amortization schedule. Month 264 is already spoken for. You're not changing anything other than, yes, you will get your home paid off sooner because the amortization schedule was based on $100,000 not falling from the sky. It was based off of a 30 or a 20 or a 15-year term. So yes, you'll get it paid off sooner, but you don't change anything about the structure. So with the home equity line of credit, when money goes in, it suppresses the balance. The bank is looking at the balance that day to determine what interest to charge you tomorrow. And you just repeat the process every single time you earn cash flow, and you'll get a faster payoff. Here's the other thing. Lines of credit can actually increase your cash flow positivity. So if you're looking at your margin and saying, hey, I've got 10 grand coming in, 5 grand going out, and nothing's going to change. I'm not looking to have more income. I'm not looking to reduce my expenses. Just by having a line of credit, you can actually increase your cash flow positivity just with that nature. And again, it's not about the interest rate. It's about the tip, total interest paid over time. Most consumer debt is anywhere between 25 and 100%. When it comes to mortgages, it's anywhere from 50 to 150%, right? So it's depending on your credit term and payment habits. But a correctly structured line of credit with a cash flow strategy reduces your total interest percentage dramatically, and it just makes modern day mortgages look irrational by comparison. Yeah, my sales manager, VP of sales, has a good quote too. Is on a mortgage, when you start paying in your mortgage, you're 5-10 years in, you're making a payment on an outdated balance. With let's say a home equity line of credit, your minimum payment is a reflection of today's balance. Does that make sense? But how it increases cash flow, let's say you got a car loan, roll the car loan into your home equity line of credit. I don't care what the interest rate is, because it's about structure, not what the rate is. You know, if you look at the numbers here, $30,000 car loan at 552, that's about a 1.9% interest rate on the car loan. Even if it was 0%, mathematically, it still makes sense to roll it into a HELOC, even if the HELOC rate was 6 or 7%. Why? Because you're going to not only increase your cash flow positivity, but you're also going to have your home paid off faster and reduce the total interest that you pay, even by combining the two together. I know that might be a little confusing, but I can always come back to it in the Q&A. So again, which one do you think looks easier? The segregated income approach, where you've got all these different buckets to stuff cash in so that they're asleep and not doing anything, or the streamlined income approach, where income goes in, expenses go out, your surplus stays in there, and you repeat the process. The modern day mortgage, it has mortgage insurance, where with home equity lines of credit, they don't have mortgage insurance. I don't care if you're borrowing 85, 90, with the exception of Texas. Texas only allows up to 80% financing, but in any other state in America, you can go 85, 90, 95, 100%. Actually, there's one credit union out in Utah that does 125% financing. They never have mortgage insurance, as long as you're working direct with the bank or the credit union. What is actually cool for me that I've seen here recently is a lot of mortgage companies get into the industry and come up with their own HELOC product. But the problem is none of those mortgage companies service those HELOCs directly. All they're doing is brokering from a bank. So some mortgage companies have got into this, and they have mortgage insurance and closing costs, where if you go to the bank directly, you're not going to have mortgage insurance or closing costs. High closing costs, where in a HELOC, it's little to no closing costs. Most of them don't have any closing costs. Some of them do. I wouldn't discount the ones that actually have closing costs, because some of those are really cool. And when I say closing costs, like one of the cooler products that are out there is like $700, $800 in closing costs. Compare that to 15, 20 grand for a $500,000, $700,000 mortgage. On a mortgage, you have to adopt a payment strategy, where with the line of credit, it's a cash flow strategy. Right? And hopefully y'all see that with the streamlined income approach. With a mortgage, you have to focus on interest rate, where with the payoff plan, it centers around rate of interest. You got large commissions on one side, the other one, it's small to no commissions. I have seen a couple that offer commissions, but you're talking about $250. So, you know, your average banker doesn't get paid a commission to do a home equity line of credit. I have seen some that they get $250, but if it was, let's say it's a $500,000 mortgage, they can make 10 grand. But if it's a HELOC, they make 250. What do you think they're incentivized to sell, the mortgage or the line of credit? With the mortgage trap, you cannot utilize 100% of your income. Well, let me back up. You could month one. Month one, you could put 100% of your income into your mortgage. But month two, you realize you made a pretty big mistake, because now it's time to pay the cell phone bill, the utilities, all this stuff. And guess what? Your money was trapped in your mortgage because it's no longer illiquid. But with the line of credit, you can utilize 100% of your income. The payment on the mortgage, it's a contract fixed payment. It's not going to change. And some people look at that as, hey, that's a great thing. But like I said, Cody has a saying where you're making a payment on an outdated balance, where with the payoff plan, your payment decreases, your minimum payment decreases as your balance decreases. You got a closed-in loan. Somebody trying to say something? No? Okay. The mortgage, you got a closed-in loan with a line of credit. It's open-end line of credit, 100% liquidity. Money in only on the mortgage, money in and out on the line of credit. With the mortgage, you're buying two homes, one for the bank and one for you in that particular order. Now, there is interest on the payoff plan, but it's albeit a lot less. So the average tip of our clients is anywhere between 13 and 15%. That's total interest percentage. So above and beyond their principal, they're paying about 13 to 15% interest. Where on a mortgage, you got a 6-7% mortgage, you're paying over 100% total interest percentage. All right. And y'all just stop me if one, you have questions or you're like, hey, we're running out of time. Why is it that more people don't know about this? The banks don't want you to know. And on top of that, they don't even know. And why don't they want you to know? Because they're going to lose money. And whose money are they losing? They're losing your money. And you'd be surprised at how many loan officers in banks don't even know that this exists. The product exists, but we've had all kinds of products under the sun for centuries. But why haven't we been using strategies combined with those products to make ourselves more, not only consumer friendly, but more efficient as well and pay less interest? So they don't know. Just like me, I started in the mortgage industry in 2001. It wasn't until 2009 that somebody said, hold up, have you ever explored this and looked at the order of payments and the structure rather than just saying that the mortgage is the only way to finance real estate? So they don't know. Just like I didn't know, they didn't know. The other thing, there's, one side you're thriving, you're paying off your home, but the other side you have to survive too. And so a lot of times I get the question is, okay, well, what happened in COVID? What happens if I lose my job? Well, always ask the inverse question. If you lose your job or COVID happens, well, what happens if you have a mortgage and you stop making payments? It's called foreclosure. What happens in a home equity line of credit world? And this happened. We started in 2014, so we had thousands of customers before COVID. And so about a dozen clients came to us and said, hold up, I'm freaking out. I no longer have income. What am I going to do? Well, at that point, they had half their home paid off. But their credit limit that they got approved for started at the point of application. This isn't something that you get reapproved for every single year. So let's say you had $500,000 credit limit and you're down to $250,000. And then you lose your job, well, you still have access to the other $250,000. Well, you can actually mechanize this, not only as supplemental income, but to make payments to itself. It can cannibalize itself, which allows you to, somewhat float. And really, it's a blip on the radar. But the biggest thing is it doesn't mean foreclosure. You get to stay in your home. And of those dozen clients are like, thank goodness I was doing this, because if I had a mortgage, I wouldn't own my home anymore. But because I had a home equity line of credit, I was able to float this short season of life until I got back on my feet and I just got back to business. So again, Jim and Rebecca, this is just kind of repeating it, but putting a name and face to it. And also some terms to this. Jim and Rebecca making $9,000, spending $6,000 a month. This is their loan, 70% tip if they had a mortgage. But if they have a home equity line of credit, it's going to get paid off in a little less than 6 years, 5 years and 11 months. So you look at the difference, they were going to pay $112,509 of interest, but they ended up saving $64,000. And they also saved, which I think is far more important than the money, is the time. They went from 30 years to 5 years, 11 months. So they save 24 years of time, pressure, stress, etc. So again, you got the mortgage you've agreed to, you pay $112,000 in interest, 30 years, tip of 69%, where with our strategy, you've got a tip of 29% and you're having it paid off in 5 years and 11 months. And obviously tons of savings on top of liquidity and a lot less stressful life. All right, I think that is it. So let's open it up for questions if we have time for questions.
Yeah, most people are still on. So we had a few questions. I tried to do a HELOC in Texas, was told by several companies we don't do HELOCs, but they advertise on billboards, yeah. So can you address that?
Yeah, there is no state law in Texas that says that you can't do a home equity line of credit. You can. Actually, it got better. Before 2018, the most you could do on a home equity line of credit in Texas was 50% of the value of your home. Now you can do 80%. So yeah, they just called somebody that was probably stupid. I have a saying: bankers are stupid and loan officers are smart. Bankers are incredibly stupid. They don't even know their own products.
Question. Let's see. Someone asked best banks for a great.
What's that?
Someone asked, what are the best banks for a great HELOC?
There isn't one. It depends on where you're located. Like you guys are in Oregon. So banks like to stick to their own footprint. So what my team does is we scour all 50 states, including Texas, and said what banks and credit unions make the most sense. And it's not just for that state, it's also dependent on that person's situation. You know, whether it's their debt to income ratio, whether it's their credit score, et cetera. So there is no one bank that it is a one size fits all. Because like I said earlier, in the HELOC world, it's still the Wild Wild West. This is a portfolio asset that sits on the bank's balance sheet. A mortgage does not. A mortgage gets bought and sold on the secondary market. This is an asset that sits on the bank's portfolio. So every bank and credit union has a totally different appetite for risk. I wish there was just one. It would make our job a lot easier, but there isn't one.
Yeah. And then someone asked, and this was a question I had initially too, is this beneficial only if you have an existing mortgage, or can you originate a HELOC for a purchase?
Yes. Yeah, you can buy a home right off the bat with a HELOC. You don't have to close on a mortgage. Now, the ones that we have seen require more of a down payment, so 10%. So if you're typically putting 3 or 5% down on a home equity line of credit, you're going to have to put 10% down. But when you start, you're not going to have mortgage insurance. You won't have the closing costs, and you won't have a mortgage. You'll have a more efficient debt tool.
And is the underwriting pretty similar to someone that's applying for a mortgage?
Yeah, good rule of thumb is if you qualify for a mortgage, you qualify for a home equity line of credit.
Okay. Got it. Let's see. Hang on. Someone said your scenario assumes that one qualifies for a $400,000 to $600,000 line of credit, right? I think that was the Jim and Rebecca scenario.
Well, no, Jim and Rebecca didn't get a $400,000 or $600,000 line of credit, but they did get a first lien position. It was 162. But to get a 400 or 600,000, that's first lien, but there's multiple forms of lines of credit. There's first lien, second lien, personal line of credit, business line of credit. So no, like I started with 10% equity. I didn't have to have hundreds of thousands of dollars of equity to pay off my $320,000 home.
Got it. And so in your scenario, it looked like they had a cash flow positive amount monthly of about $3,000. Did I calculate that right? Because they income of $9,000, expenses of $6,000. So even with only a $3,000 cash flow monthly, that allowed them to pay off their mortgage 24 years sooner.
Correct. Now,
So you
don't make the mistake. Don't make the mistake of thinking it was just the $3,000. It's not the $3,000 that's going to work. It helps because it stays in there. That's your cash flow positive margin. That's that surplus that stays in there to continue to suppress the balance. But all $9,000 work to reduce the interest, not just the portion between the income and expenses.
Okay, got it. And then another great question from Holly. Is there a different strategy for mortgages on investment properties that you'll hold 10 years or less?
Yeah, so you can get a HELOC on an investment property that is 20% down. Really no different than mortgages. Mortgage world, it's any 20, 25% down. HELOC world, there are purchase programs for HELOC and it's 20% down. I wouldn't focus on trying to pay off multiple properties at the same time because again, you go back into the segregated income approach. And I'll tip my hat to Dave Ramsey, debt snowball. What does he talk about? Focus on one debt at a time. No difference in this. Let's say you had 5 different HELOCs. You got your primary residence and 4 rental properties that all have HELOCs on them. I wouldn't take your 10, 15, 20 grand and split it up amongst all HELOCs. I would focus on one at a time. Mathematically, that will save you more interest than to try to tackle them all at the same time.
So would you tackle your highest tip percentage first or your highest balance first?
Mathematically, you would attack the highest cost of funds first, which tends to be the higher interest rate. That's a mathematical answer. That is not an emotional answer. I didn't do that. I focused on my primary residence because in 2008, I went broke, bankruptcy, foreclosure, the whole 9 yards. Didn't have kids, thank God. Now I've got 5 of them. So I locked down the family homestead first before I focus on debt that other people live in. So there's an emotional answer and there's a mathematical answer. In our program, same thing with that snowball. There's a mathematical answer and then there's Dave Ramsey's answer. Dave Ramsey's answer, start with the smallest balance and then work your way up. You get emotional wins. It's about human behavior. There's also a mathematical answer. You don't actually start with the smallest balance. You start with the highest cost of funds first.
Got it. Okay. Other questions? Y'all can unmute yourselves if you want to ask a question. All right, Carly.
Hi, I'm still trying to get my head around it, and I don't really understand HELOCs enough, so I'm probably gonna have to go away and do some homework. But just thinking it through, I had a mortgage in Australia that had like an offset account with it that basically offset the interest on the mortgage. So is it basically like that? Your HELOC is going to be like an offset?
Yeah, so it's not just offsetting. Let me show you how HELOCs calculate interest. So let's say you've got, actually, I think I've already got it written somewhere. Let me see. Pretty certain I do. Yep, here we go. All right. Y'all see this okay?
That's better. Yeah, thanks.
All right, this is a line of credit, home equity line of credit. You got 100 grand. Let's say the interest rate is 5%. If your balance is 100 grand the entire year, you're going to pay $5,000 of interest. So this is how the bank calculates interest. They take 5,000 divided by 365 because it's called per diem, daily interest rate. So that ends up being $13.69 per day if you don't put money into it. If you just max it out and you just keep it there, you're going to pay $13.69 per day. So over a month, that's $410 a month. Oop, I wrote on it. I don't want to write on it. So let's look at month one. You know, I like to work with easy round numbers. Let's say you got 10 grand going in. So you start off at 1369, but 10K goes into the home equity line of credit. Any confusion of why you would put money or would not put money, all of your money into the home equity line of credit? Is there any, it works just like a checking account. Do you put 100% of your money into a checking account first and foremost, and then maybe put it somewhere else after the fact? Yeah. So you're going to do the exact same thing. You're just bypassing the bank altogether and no longer using, I'm not saying close, but you're no longer using your checking and savings account. So 100% of your income goes in there. So now the balance drops to 90 because 100% of what you put in goes to principal first. Then the interest is calculated, the opposite of a mortgage. So now you're paying $12.32 per month. Well, what we want to do is we want to keep our money in there as long as possible before we pay our bills. So in fact, I pay my bills once every 7 months. That's a whole ninja thing that we get on at a later date, but I pay my bills once every 7 months. But if you're looking at a monthly cycle, then you want to keep the balance in there as low or as long as possible, and then use the HELOC to pay your other expenses at the same day. So let's say it's 29 days, you got 5,000 of expenses. Now you go up to 95,000, you're at 1301. Now let's move to month two. So you already dropped $5,000 worth of balance just in month one. Month two, you start off at 95,000. You got a new per diem. 10K comes in, 85 going out, 1164 for 29 days. Another round of expenses, you're at 90K balance in 2 months. So it doesn't seem like a big deal to go from 1369 to 1164 in 2 months. But when you start compounding that, those wins, $100,000 is gone in 22 months.
And you still have access to
100% liquidity.
all of that, to the equity that you don't get access to in a mortgage.
Correct.
If you needed it, if you have the emergency, if you whatever need to, yeah, exactly. Okay.
Real estate opportunity.
So there's a good question in here from Holly. Is there a seasoning period required before getting a HELOC on an investment property, or do you just wait until you have a certain percentage of equity? Sounds like you can do 10% down.
It depends on the bank and the state. So there are banks that allow you to purchase, so it means there's no seasoning. So if they offer a purchase money HELOC on an investment property, there is no seasoning requirement. So don't start with a mortgage at all with them. You just purchase it with them. And even if you already purchased with a mortgage, there is no seasoning. But it's, again, I can't stress this enough. If you remember the mortgage world prior to 2008, that's the way HELOCs are today. It never changed because the government doesn't have their grubby hands on this industry. Every bank and credit union can do whatever the heck they want.
And does that work for a primary property as well, or primary residence, not just investment?
Yes, yes, it's most attractive on the primary residence.
Okay.
So much information. I know this is like mind blowing. It was for me when I first learned about it. And it's just like, you have to shift your thinking because we've all been taught to chase the rate, right? So there's so much more information. Obviously, Michael has a whole 6-hour presentation. So we did put the link in the chat. Also, if you click or snap the QR code here, it will take you to the website where you can learn more and dive into this if you're, really committed to wiping out debt and or using debt strategically in a way that can help you continue to build your wealth.
Okay, can I ask a quick question?
Mm-hmm.
Michael, if say you have a mortgage of, let's say, 350,000, and your interest rate is about 4%, and you have $100,000 HELOC in place that's good for 10 years. How would you, if you could just do that quickly, like explain, how would you put this to work, this kind of approach?
Yeah, that would be a chunking strategy. So what you're wanting to do is get as much of that mortgage onto the HELOC so let's say you got 100 grand over here and you got 350 over here. You may say 320. You want to take 100 grand, put it onto the mortgage. Now there is a let me just speak generally. I'll do generally first and I'll get into the actual specifics of it. Take 100 grand, dump it into the mortgage. Now you owe 250 on the mortgage and 100 grand here. So you didn't go further into debt. You just rearranged your debt. Now that HELOC over there, you dump all of your income into, it eventually gets paid off quicker than the mortgage would. Then you do another 100 grand. That's called a chunking strategy. Now, what we do is we put all the math together and all the analytics together because it may not be most mathematically efficient to put all 100 grand at the same time. Maybe you start with 10, maybe you start with 15, maybe you start with 20. So that's what our team does, is analyze how much you should be chunking to save the most amount of interest.
Okay, thank you.
Mm-hmm.
Any other questions out there? Larry, you want to say anything?
Yeah, can you hear me okay?
Mm-hmm.
Yes.
Okay. I just want to say that I was actually introduced to this program through a friend back in June of 25, just about 8 or 9 months ago. And I went into a deep dive into a big session like this. I went through that long strategy session with Michael and his staff because I wanted to really get all the nuts and bolts. And I joined the program. And the part that was so interesting was the coaching that you get with the strategy. Like I had questions, just like everybody's asking questions. There's a lot of information here, and I wasn't smart enough to go, oh, this is good. So there's a link in the chat where you can go in, and they're just going to ask for your name, email address, and phone number. And then you can actually go in, and Michael does a 20-minute quick overview, which I think summarizes a lot of this conversation, Michael, if I can.
Yep.
And then at the bottom, he says, if you have interest, click on this form. And the form is just an online form that you fill out that says, what's your credit score? What did you pay for your home? What's it worth today? What's your P&I? Just simple questions like that, about a dozen of them. You submit that, and the calendar comes up, and this is critical to me, to get you schedule a call with the discovery specialist. The discovery specialist, when I talked to the discovery specialist, they took the numbers I gave them from my form, and they said, here's what you're doing right now. And I had to step away for just a second. I don't know if I heard him talking about it, but this is what you're doing with your mortgage company currently with this payment. And then it gives you the replace your mortgage strategy. And it says, this is what you would be doing. That discovery specialist, that's about a 20 or 30 minute Zoom is all it is, because you've already given them the numbers. In that 20 or 30 minutes, they're going to give you your potential outcome so you can see exactly what it could mean to you to have this outcome. And then if you like what you see, then they'll connect you with the enrollment specialist who will, it's a 45 minute Zoom that will actually go through, dot the I's, cross the T's, answer all your questions. And it's really a simple process once you understand it. It took a little while.
It's third grade level math. It's not tough math.
It's not tough math at all. When you see, listen, I got aggressive with mine because I had a lot of extra cash flow. I had 26 years and 4 months left on my rental next door to my house in Texas. And so it does work in Texas. I had 26 years and 4 months left. I paid it off in 5.5 months through this strategy. So, I'm telling you, it works. And that's why I just love for people to find out about this. But until you get on with the discovery specialist and find out what you're actually doing now and what you're, when you start seeing your total interest percentage and these kind of things, and then you look at over here, it's amazing how you go, this is, to me, it was a no-brainer, but that's what you need to find out until there's no cost for you to find out the numbers and stuff. So just go in and find out. And if it makes sense, move forward. If it doesn't, pass. I think that's as simple as I can put it, Michael.
Yep. Yep. Good job.
But thank you all for jumping on to be a part of this, because I every time I get a chance to hear Michael, I mean, I'm sitting here with my journal and pages of notes already just from the things I'm still learning. And I've been, paying attention to this since June of 25, because I want to learn as much financial education, because that's what his company specializes in, financial education. This is just one of the companies under the umbrella of it all.
Yeah.
Larry, do you use this in conjunction with the Bank on Yourself?
Yeah, I've been using Bank on Yourself for 16 years. So and unfortunately that's not with Michael, but I started that a long time ago, and I've done a lot of things with my infinite banking. And so if you don't know about it, it's certainly a great thing to learn about as well, because I've invested in companies. I've done all kinds of things with infinite banking. Yeah.
Thank you.
You bet.
Yeah. We've got one last question from Debbie, and then we'll wrap it up.
Yeah, thanks, Larry, for that endorsement. Michael, can your office run scenarios for us?
Yeah, that's all we do. That's what Larry was teeing up. That's the first thing you do is we run scenarios and because I'm going to be transparent, not every American should entertain this, because unfortunately in America today, most Americans are living paycheck to paycheck. They don't have cash flow positivity. So we want to make sure that your cash flow positivity margin in relation to your debt load makes sense for this. So that's what the discovery specialist does, is they're running your numbers, third grade level math, and saying, okay, and we also get to use the word guarantee, because we're looking at your current situation. What you're going to pay is a guarantee. We're also looking at the new situation. What you're going to pay is a guarantee. So the savings is guaranteed, but they have to look at that first to see if this makes sense for you.
Okay, and then are you guys licensed in all the different states? So if we use your discovery specialist, then if we want to move forward, we can use you.
Correct. All 50 states.
Thank you.
Until we get Canada.
Excellent. Well, I appreciate everyone staying on. Obviously, a lot of interest in this topic and in the infinite banking, and it could be interesting to see how to marry these two strategies together. So perhaps a future meetup, you never know what we'll come up with next. So just again, want to thank you, Michael, for being here and sharing your wisdom and your process and your program, and Larry as well for sharing your experience, putting this into practice. And I mean, 5 months is, I'm sure, record time for paying off your mortgage. So yeah, it's just great to know that it is not only possible, but you did it. So there's lots of contact information in the chat. So I encourage you all to capture some of that as well. We will post the replay on our YouTube page, on our Central Oregon Investor Network Facebook page, we'll have a link as well on our social media. And then if you follow us on social, you'll also be connected to Michael's handles as well. So just appreciate everyone for joining. Thank you so much. And it's great to have everyone, and we'll see you next time. And
thanks.
Thank you, Suzanne.
Thank you, and
Larry.
Sarah.
Thanks, Michael.
Thanks you and Sarah both for having us on.
Thank you. We'll see you all next time.